Hi, I'm Lauren Taylor, Managing Director of Active Property Group. As the economic landscape continues to shift in 2026, Australian investors are facing new challenges. Unknown interest rate changes, higher property taxes, global market instability, and new regulatory pressures affecting both rental property owners and equity investors. In response, more Australians are exploring pooled mortgage funds, which is a form of private credit investment that provides regular income backed by Australian property. These funds have emerged as one of the strongest performing alternative investments in Australia, offering diversity, balance, and yield in an unpredictable environment. Today, we explore the 9 reasons why pool mortgage funds are becoming a preferred investment in 2026. Number one, stronger yield potential than traditional fixed income products. With term deposits and government bonds offering relatively modest returns, pooled mortgage funds have positioned themselves as a compelling middle ground, offering higher yields, lower volatility, and consistent income. This balance makes them especially attractive for investors seeking dependable property backed returns. Number two, built in diversification. A key benefit of pooled mortgage funds is diversification across multiple borrowers, different loan types, various security properties, and multiple geographic locations. Instead of relying on the performance of a single property, investors gain exposure to a broad loan portfolio. This diversification helps reduce risk and smooth out returns over time. Number three, professional management. In a lending environment where borrower quality varies and valuations must be carefully assessed, having professional oversight is critical. Pooled mortgage funds are managed by specialist teams who source and evaluate borrowers, conduct thorough due diligence, maintain conservative loan to value ratios, manage loan performance, and oversee the recovery process if needed. This level of professional management removes the complexity and risk that individual investors would face if trying to lend privately on their own. Number four, a lower entry point. Buying an investment property often requires a six-figure deposit, plus stamp duty and upfront costs. For many Australians, that level of capital commitment is difficult. Pooled mortgage funds provide an accessible alternative, with APG's minimum investments starting at just $10,000 for retail investors and $25,000 for wholesale investors. Number five, loan security and capital preservation. Mortgage funds are backed by Australian real estate. If a borrower defaults, the property can be sold to recover the loan amount and interest. At APG, a maximum 75% loan to value ratio is used as part of risk management, ensuring a reasonable equity buffer on every loan. Depending on the risk of the loan, we will often lend at a much lower LVR. This conservative approach provides investors with added protection in a fluctuating property market. Number six, consistent income. Many investors, particularly retirees and those building passive income, value predictable debt distributions. APG's pooled mortgage fund pays quarterly distributions, allowing investors to enjoy stable, recurring income. Those looking to compound returns may also choose to reinvest through the distribution reinvestment plan. Number seven, tax changes for investment properties. In recent years, several federal and state policy adjustments have reshaped the tax landscape for property investors, and proposed changes could see an even greater impact. These changes can directly affect the profitability of traditional investment properties. Pooled mortgage funds, while backed by property, remove the headaches associated with a changing property investment market. Number eight, arduous investment property ownership. Aside from tax changes, owning an investment property has become a less attractive prospect because of larger mortgage repayments due to higher prices and interest rates, changes to tenancy laws, rising insurance and strata fees, higher maintenance and repair costs. For many Australians, these pressures can cause net rental yields to shrink. In contrast, pooled mortgage funds provide property linked income without the financial and administrative burdens of property ownership. And number nine, global market volatility. Uncertainty in global economies, fluctuating interest rate policies, and ongoing geopolitical instability have led to increased volatility in equity markets. For investors relying on predictable income or stable capital growth, market swings can be unsettling. Pooled mortgage funds, however, generate returns through contracted interest payments, not day to day market movements. This allows them to deliver far more consistently than shares, ETFs, or other market sensitive assets. If you'd like to learn more about pooled mortgage funds and how it can help you reach your potential goals in 2026, then get in touch at investorrelations@activepropertygroup.com.au. Thanks, and see you next time.